This is a CBS News special report. I'm Lana here with Enrique Acevedo. The Federal Reserve has just announced it is raising interest rates by 0.25 percentage points. It's the first rate hike since 2018, and it comes after the central bank cut rates to near zero at the start of the pandemic.
Today's move is the first of several rate hikes this year and over the next couple of years in an effort to curb the worst inflation the country has seen in 40 years. While the interest rate may help slow inflation, it will come at a price. And to talk about that, we're joined by Stephen Gandel, the news editor for Dealbook at the New York Times. Stephen, welcome. The price of gas, the price of food is up, and we have the highest level of inflation, as I just said, since 1983. Americans are paying more for their everyday expenses. What will this rate hike mean for all of us?
Well, it's no magic bullet, right? I mean, these things work, but they have to work their way through the system. The thing that's different this time is, unlike the last time we raised interest rates in 2015 and then in 2016, it was a year between the two interest rate hikes. This time, the Fed, we know, or we expect, that the Fed's going to raise interest rates pretty regularly over the year, over the next year and a half. And so I think you're going to see movements in interest rates and effects on the economy quicker, right? The good news, your savings account is probably going to pay a little more pretty soon. Bad news, it's probably going to cost you more for your mortgage payment if you're refinancing your house, or even your credit card bill is going to go up.
Mm-hmm. Stephen, some experts warn that the U.S. could experience stagflation. That's, as you can tell from the name, when the economy stagnates and inflation continues. Tell us what that would mean for economic recovery efforts.
Well, it's just, there's so many echoes, it feels like, of the 70s, especially recently with the price of oil going so much. That's why people start talking about stagflation. But when I talk to experts, I talk to economists, people in the market, no one really thinks that's where we are, right? The wages are up, but they're still lagging inflation, which means that the pressure on prices is coming from a lot of things like coming out of the pandemic, the lack of supply. It's coming now from geopolitical problems. It's coming from the price of oil. Stagflation is really when wages are kind of pushing everything up, and we're not there yet.
Were you surprised by the announcement that there are going to be 7 hikes in this next couple of years?
Well, you know, the market was kind of split between 6, 7, and 8. So that's kind of right in the middle. That's kind of what I expect. And that's what I mean, right? Because, as I said, last time it was a 0.25 point in December 2015, and not another 0.25 point and not until December 2016. This time we think we're going to have 0.25 points pretty regularly. And so I think that means that banks will relatively quickly move up the saving rates, which, as you probably know, if you've looked, it's almost nothing what you're getting paid. They'll move that up, right? Since we're forecasting somewhere around 2%, from 0 to somewhere around 2% in about a year. They'll move that rate up, but at the same time, mortgage rates are going to come up. And the thing that's tough for consumers, it works its way through the system, but no one really knows when this is going to slow down inflation, again, because there are so many factors working into why prices are rising right now.
All right. Thanks, Stephen. I want to bring in now Megan Greene, senior fellow at Harvard Kennedy School and global chief economist at Kroll. Megan, Enrique and I were surprised, actually, when we heard that there were going to be 7 plot point increases over the next year. Economists before this were predicting between 7 and 8 over the next 2 years. Tell us, what is the thinking that went into the Fed starting to hike these interest rates, and how quickly it seems like these interest rate hike increases are going to happen?
Yeah, if you compare the forecast now with the forecasts in December, they have completely changed. I actually still think 7 rate hikes this year will be difficult for the Fed to pull off, but the whole point of doing it is to reinstate the Fed's credibility and show to people and investors that the Fed is really on top of inflation. Because the Fed's worst nightmare scenario is that actually nobody believes the Fed can do anything about inflation anymore. And then inflation expectations start to become what we call de-anchored, which means everybody thinks inflation's just going to go up forever. When that happens, people pull forward their spending. And with all that spending, it actually drives inflation up. So it turns into this kind of self-fulfilling prophecy. And what the Fed is trying to do today in particular is to make sure that everybody knows the Fed is going to fight against inflation so that those inflation expectations remain fairly anchored so that people continue to think that over the long term, inflation will go back down to 2% and don't pull forward their spending.
So, Megan, just a follow-up question to you on that, because the Fed is trying to signal that it's taking aggressive moves against inflation by announcing this. Is there a possibility that that if this starts to cool down those inflationary pressures, that the Fed might scale back from these seven plot point increases over the next year?
Yeah, absolutely. The Fed chair has highlighted that the Fed needs to be nimble and respond to data as it comes out. And that gives the Fed the flexibility to do more or do less, depending on how the data is coming out. I do have to say right now, given the Russian and Ukraine conflict, the issues that will cause in supply chains, especially for batteries and semiconductors, and now the shutdowns of factories in China, the supply side reasons why inflation is much higher seem to be getting worse. And so I think this year, the Fed will have to continue to really fight against inflation.
Megan, the story dominating the news, of course, is the war in Ukraine. Do you think that has played a role in the Fed's thinking in making this decision?
Absolutely. The immediate impact is, of course, on gas prices at the pump. I was just in California. They're over $6 a gallon, which is incredibly high. There's nothing the Fed can do about high oil prices, of course. That being said, the Fed really needs to keep these inflation expectations anchored. Other commodities like nickel, aluminum, palladium, all key inputs into batteries, cars, semiconductor chips, all things we've had shortages of anyhow. Those have been affected by the Russian invasion as well.
So, Megan, just really let's make it simple. Is relief anywhere in sight for Americans then?
Unfortunately, I don't think huge relief is coming this year. The Fed expects inflation to go down to just over 4% by the end of this year. It was 7.9% in February, so that is a deceleration. That being said, oil prices are going to remain elevated. I think commodity shortages will continue. And so that should keep prices elevated for a while, and that will eat into people's living standards. But if the Fed can start to lean against this, but not so much that they actually choke off growth, then relief can be in sight, starting next year, I think.
That would be good news. Thank you so much, Megan Greene. Now we go with senior White House correspondent, Weijia Yang. She, of course, is at the North Lawn of the White House. Weijia, we knew this was coming. We saw Chairman Powell tell lawmakers in Congress not too long ago that this was coming. But what's the thinking right now at the White House?
You're absolutely right. We were already having this conversation several months ago when it was not the conflict in Russia and Ukraine that was impacting the inflation rates, but it was the global pandemic. And of course, we see a resurgence of that because when we're talking about inflation, we're really talking about supply and demand and the inability to meet the demand with supply. And because so many factories were closed down around the world, many of which were in China, which of course took a extremely heavy hit. That is something that the government has been dealing with for years now. So for months, the White House has been saying that they do anticipate a rate hike. And then, of course, we saw the invasion into Ukraine, which changes the game even further after the U.S. and the UK and the EU has promised to sanction the energy sector as one example. But I think right now, the president is already under so much pressure when it comes to inflation, when it comes to helping Americans make everyday ends meet. But they wanted to be really careful, guys, not to make this appear in any way a decision by the White House. The press secretary has said many times that this is independent, that the decision to raise those interest rates is separate from the White House, meaning that the president and his national economic team has not tried to influence this decision. Of course, they can only remove themselves so far because the president just recently renominated Jerome Powell to be the chair of the Federal Reserve Board and have several other nominees to serve on that as well. They are the decision makers. And so I think what we'll hear at some point today from the White House is that they do support this decision. And of course, they will hope that it has an impact on bringing those prices down. But as we just heard from your guests, it really is difficult to put a timestamp on when that may be, given all that we are seeing around the world, including new shutdowns in China.
All right, Weijia, thank you. As we've just heard, the Federal Reserve has announced that they are increasing interest rates. It is the first interest rate increase since 2018. They're increasing it this time by a quarter of a percentage point, but they are also planning to raise it 7 more times, we have learned, over the course of the next year, and those rate increases might continue into 2023. Our coverage will continue here on CBS News Streaming. This has been a CBS News special report. I'm Lana with Enrique Acevedo in New York.